Well, recently I watched a lecture by Jonathan Feingold Catalan, who some of you might recognize the name. He is maybe currently the most prolific writer on Mises.org, perhaps. I mean, I'm sure posthumous Rothbard and Mises articles outnumber his, but he writes, it seems like 2 or 3 a week, and he has his own blog, and he writes a ton, and he's a very, very knowledgeable economist, even though he doesn't have a degree yet. He's a really young guy. He's a really cute guy. He's got interesting nationality. He is a Spanish, Catalonian, Jewish American. And he used to be in the, well, he used to be really into the army and war and stuff, but now he's definitely a hardcore libertarian. Anyway, point of this video isn't to extol his many qualities, although I could definitely do that for a while, but just to address a lecture he gave. Now, he's been writing for a long time, and finally it paid off in him getting to lecture at the Mises Institute in Canada, and he gave a lecture on free banking, and I decided to make a video on it because it's one of those few issues that libertarians in good faith can disagree. There's a couple. Abortion's one of the biggest ones. Intellectual property, although that's becoming less one. I think the Kinsella arguments have basically swept the field as far as that's concerned. But free banking is one of them. On the one hand, and Catalan puts it this way, you have what he termed the Rothbardians, or the gold standard people. How you use the term gold standard varies a little bit, but basically the idea that anything other than 100% fractional, or anything other than 100% reserves is not only fraudulent but inherently unlibertarian. And then you have the other side, which says if who are against central banks, they're against any government involvement in money whatsoever. In fact, could quite possibly be anarcho-capitalists, but who think if a bank wants to issue notes over and above reserves, aka if it wants to engage in fractional reserve banking, there is nothing necessarily anti-libertarian or fraudulent about that. And fortunately about this debate, it's not that much of a wedge issue, and I'm glad, because it really shouldn't be. It'd be one thing, as far as I can see in terms of monetary policy, the big difference between any kind of Austrian insight and the rest of the mainstream is that the mainstream seems to believe, whether it be Chicagoans, Keynesians, Marxist, government in general, that in order for an economy to function and or to grow, you have to have an expansion of the monetary base. You have to have an increase in fiduciary media. And if you don't, you automatically get depression. And this, of course, is silly. The idea that, it's absolutely the death knell of an economy to have 1 or 2% deflation, because then no one can calculate, but then having 4 or 5% inflation's good, or not bad at least. I mean, that doesn't make any sense. If it's hard to calculate 1 or 2% deflation, it would be even harder to calculate 4 or 5% inflation, or 10, or whatever the number is. And I think that the free bankers and the hard money people both realize you don't need to have credit expansion for the economy to grow. I might be wrong in this. I haven't read all the free bankers. The only one I'm really familiar with at all is George Selgin. And as far as I'm aware, he never claims that, look, if the economy is in stagnation, you gotta print money. That's the only way. I don't believe that they think that. All they say is that if a bank wants to issue fractional reserve notes, it should be allowed to. And I am kind of two minds of this. If I had my choice, I would rather have my bank not be fractional reserve. However, if other people are happy risking their money in a bank like that, I don't see how that's my problem, and I don't see how that's unlibertarian. Everybody agrees, even the Rothbardians, that even a fractional reserve bank, if it isn't subsidized by the government in the form of, say, outlawing bank runs, or providing additional credit whenever they need it, aka through the FDIC or a central bank, there are market mechanisms that prevent private banks from inflating ad infinitum. This is, as far as I know, a Misesian insight, although it could be from before him, either Bumbovic or maybe even Menger, and who knows, maybe even some of the neoclassicals. But if you're a private bank and you have no state sanction, you cannot inflate forever, especially if there's competition. The main problem I think the Rothbardians have is that they consider it fraud. And there's two problems with that. One, fraud is one of those things where it's a little bit harder to tell for sure whether it's coercion or not. And the other is that it's not necessarily fraud. So they would say if you put your money in a bank and it loans out all your money, but you think that it's there on deposit, then that's fraud. On the other hand, they may just say, look, we're not going to keep your money on deposit. It's not explicitly on a time deposit. You can get it on demand, but we are going to loan it out, and there is always the risk that the people that we loan to will not be able to pay it back, and there's a chance that we could run out. I don't consider that fraudulent any more than, say, giving money to buying stock. Say you buy money or put some of your investments to a stock, and then the stock fails. That wasn't fraudulent. That's just a risk you took. I can see how people like Gary North wouldn't like it because he would consider it against God and a sin against honest weights and measures to claim that it's all there. But if they don't claim that, I don't see what the problem is. If they say, look, we're going to loan this money out, and the plus is going to be they probably won't charge you a fee then. I mean, if you have two banks, one says they have 100% reserves, and they do, and the other one doesn't, and that they practice fractional reserve banking. If you put your money into the Rothbard Bank of gold, you will guaranteed have to pay some kind of fee. Might not necessarily be a very high fee. If we're talking free markets, competition is going to drive down the prices, and they might be very reasonable. But if I want to deposit 10 ounces of gold, and they say, well, it's going to cost 0.2 of an ounce for a year, versus the Seljonian Bank next door, it says, look, deposit your money, it's on demand, but there's a chance that if there's a run on the bank, we won't have your deposits. I think that market participants should be allowed to make that choice, and if you lose your money in the one, tough on you. And if you end up losing all your savings, paying storage fees at the Rothbardian Bank, which I don't think would ever happen because people would see they're losing, but whatever. The other problem is there's no way it could possibly be enforced. Let's say that you had a bank and it had 900 ounces of depositors' gold in its vaults and 100 ounces of its own gold that it either raised through fees or its own initial capital or whatever. And so if you were a Rothbardian, you would say, well, they can loan out 100 ounces, but that 900 ounces, that they can't because that would be fraud. Well, let's say they loan out the 100, and then they loan out 1 more ounce. What are the odds that that's ever going to be caught? I mean, for a run on the bank to reveal, for them to be unable to meet their demands, literally every single person would have to come in and demand their entire balance. So if you even had one person who was sick in bed that day, they would be able to meet their demands. And so there's no way that you would be able to guard against at least a certain degree, how much no one can say for sure, of fractional reserve inflation. And I mean, 1 ounce, we know that they wouldn't. 2 ounce, probably not. If they loaned out 100 ounces, probably not. If they loaned out, of the 900 of their depositors, if they loaned out 899 of those ounces, okay, there's a good chance. But that's the point of people start noticing the notes going out in redemption, or the additional notes, because obviously they can't print more gold, at least yet anyway. The main impetus against this is not going to be any kind of rating agency. It's going to be other banks. Uh, Actually, I read a fascinating story. I don't know how true it is, but basically that China was on a silver standard up until World War II, and that banks would issue notes. And what would happen is on every Friday during the week, each bank would accumulate many of the notes from the other banks. Say there's 5 banks in Shanghai, and Bank A gets not only its own notes redeemed, but also notes from banks B, C, D, and E. Well, on Friday, they send 2 guys with a little cart over to the other banks with all their notes, and they say, we want to redeem these. And all 5 banks do this to each other all at the same time. And if any bank fails to meet the demands from the other 4 banks showing up with their card, their notes, then everybody will know that that bank is insolvent, and that bank will fail. And so they have an incentive to be able to meet a maximum level of demands. So, I mean, this is something even a state could never even hope to prevent from happening, let alone a libertarian regulatory agency. And I'm not saying that libertarian regulatory agencies are less thorough than a state. For all intents and purposes, they are more thorough, but they still wouldn't be able to prevent it. Now, the other issue here, and this is one that I've heard from Guido Hülsmann, who's one of my favorite living Austrians, basically that any inflation is bad, and how he defines it is any creation of fiduciary medium above natural money creation. And this, I think, is problematic because it's kind of, as Austrians understand, more money in a system does not make the system richer. So if gold is functioning as money, well, as a commodity, if we had more gold, we would be richer, because gold has useful things that people value. We could all have more jewelry, we could have better electronics and whatnot. But as a money, more gold is neutral. You know, I heard once that we had 4,000 tons of gold in the United States. Well, if we used gold as money, it wouldn't matter if we had 4,000 tons, 2,000 tons, or 8,000 tons. It would really be immaterial, especially now in the digital age. So that being said, if we have a gold standard or a commodity-based money and I mine 1 more ounce of gold, Guido Hülsmann would say, and I coin it into a coin, Guido Hülsmann would say, that's fine, that's not inflation, but it is. You've increased the money supply. You've lowered the value of all the other gold coins in existence. But he would say that's okay. But if I was a fractional reserve bank and I issued 1 note on top of a coin, he would consider that bad, although it would be the same in effect as mining an extra piece of gold. The only difference being that, I mean, it would be the same in terms of inflation. Now, with the former case, if you didn't use the gold as a coin, but if you used it as a material, we would be wealthier. But in terms of just monetary economics, it doesn't make any difference. So I think that his definition, he wrote a book called The Ethics of Money Production, and to his credit, I mean, this is a field that very few people have really looked at all, and he makes a very good effort, although an extremely Catholic one, to come up with an ethics for money production. But I just don't see how it's okay in terms of money to coin an ounce of gold or an ounce of silver. And he actually thinks that silver would probably be the money of choice rather than gold. I actually personally think that we would have multiple standards. There would be, as long as they're not set in relation to each other, that's fine. Yeah, I mean, personally, I think that we're in the digital age right now, and most people are not going to be carrying around gold or silver coins. They're going to have a debit account, and it's going to say so many ounces of each. There'll probably be convertibility that will change automatically over time, and then you could make exact change, like not to the penny. I mean, right now, if something's half a penny, you round up or you round down. But if something is half a grain, that's really easy to just say, oh, it's half a grain. And then your bank can have bars, it can have coins, and then it can have smaller things. And I've even seen, even right now, you can get milligram pieces of gold. It's basically like a strand of hair, and then it's in a plastic, like a credit card. And I mean, that's great. I mean, that costs $2 or $3, but you could make small change, but you could easily cut that in half and have half a milligram, and or have a little bit. I would imagine a bank would probably have a couple pounds of gold dust just to make really exact change. You come out and take out your entire savings, and it could be 3.897432 or 3.1459 ounces of gold, and they give you 3 ounces in coin, and then maybe a 10th ounce coin, and then they get a scale. Maybe you could bring your own too, just to be sure. And they could, well, you bring your own weight that you know. That would be the really smart thing. And they can go and they pour out the grains until they get to 0.0459 or whatever, and off you go. The only times you would really be handling money is if you didn't trust your bank, if you were going to transfer funds, or if you just like to keep a certain amount, just like some people like to keep cash as opposed to electronic money now. So I think we're all free bankers, and I think the problem here, because I think the problem, I hate saying this, lies with the Rothbardians, because the free bankers, so-called, never say that you can't have 100% demand deposits if you want them, which I would prefer. And the Rothbardians are the ones saying you can't have fractional reserve banking. But if people don't mind using a fractional reserve bank, so be it. It's one thing if the bank is lying to them and saying, look, these are, I mean, you could have time deposits where you put your money in and they say, look, you're loaning us this money, we won't pay it back to you until after 6 months because we're going to be loaning it out ourselves, or we'll pay it back to you but only at 80% because, you know. Now if they tell you it's a demand deposit, you can have whatever you want whenever you demand it, and they've loaned it out, and they explicitly say that, yeah, then they're committing fraud. But there are market incentives against that. But if they explicitly say we're going to loan this money out, and I actually believe that they would be able to tell you, hey, we're going to loan this money out, but it is a demand deposit. I think that most banks would actually be able to operate doing that, and the trade-off would be there'd be a risk you might lose your investment, but it would be relatively small, and then you wouldn't have to pay a user fee, and you would have your choice between one or the other, and any number of other alternatives. And so I don't think it's that big an issue. I know personally, I'm just a gold bug. I'd like to keep it as safe as I can because it's my money, it's my earnings. I'd be very, very dubious about putting my savings into something that is, in essence, a speculative affair, which is what banks are today, by the way. It's also speculative as to whether the government will bail them out. That makes that even worse. But, yeah. Oh, and then the other thing I don't think people realize, this is a little bit off the topic, but, you know, you say, oh, people would never accept gold or silver over a fractional reserve note. I think that's absurd. If anyone in the world goes to their boss and their boss says, I will pay you in either a deflationary medium, an inflationary medium, or a stable medium, which is not possible because the relative value of all goods is changing all the time. There's no such thing as a stable money, but let's just hypothetically imagine it. Which one would you prefer? Every single person in the world will say they want the deflationary one. Nobody, because there's no reason not to. Even if you plan to spend it right away, it doesn't hurt you. If you plan to save it, it helps you. All the other ones, they hurt to save, or they for no benefit. And so there is an incentive for people to want to be paid in a deflationary medium. And at the same time, that same incentive is there for businesses to accept payment in a deflationary medium. If I was running a business and someone said, well, would you rather I pay you in these fractional reserve notes from the Seljonian Bank, which go up, down in value, or Federal Reserve notes that really go down in value, or would you rather have me pay you with gold, which goes up in value? What businessman in the world would choose the former? They would always choose the latter. And that, I think, is the clue on what would end up circulating in a market economy. At least that's what I think.